So feel free, raise your hand. There is no such thing as a stupid question in my book, but leaving here without understanding the topic at hand, hey, it's up to you guys. I want you to retain as much knowledge as absolutely possible. So with that, we're going to move on to the arbitrary risk disclaimer. Guys, you have probably seen a million of these. You'll probably see a million more. As always, just taking a brief moment to say, hey, trading is risky. We can make money. We can lose money. Know your limits in regards to trading. So feel free to review this. It's in all of our slides at your personal discretion. Now, here is the main topic of today, oil and gold. We've alluded to this, and we're going to take an in-depth look at commodities. We're going to look at some fundamental factors that play in these two markets. Likewise, we're going to talk about the technical aspect. That's going to be the correlations to these different assets. How do they size up on the charts? Are they in an uptrend? And how they pair off with each individual currency. Last but not least, maximizing your opinion. Now, it looks like there's about 100 of us here in the room. I may be a bull on gold. You may be a bear. Regardless of how you wish to trade that asset, you're going to be able to use the different correlations to maximize that opinion. So let's get right to it, guys, and talk about the case for commodities. Now, everybody here has seen the big run-up in gold. And certainly it's been one of the fastest moving assets out there in the market. Now, why? It's a store of value. In these times of unprecedented economic decline, guess where people are parking their money? They're putting it in something that they know is going to have relative value. Now, not only that is it a great way to park your cash, but you'll see that it's going to be an industrial metal as well. Many people don't know that gold is going to be used in many different semiconductors. You're holding a cell phone in your hand. Hey, you probably have a little bit of gold inside of there making that machine operate. So you'll see that gold is going to fluctuate with economic cycles of supply and demand. Next, we're going to talk about the dollar decline. All of the assets we speak about today is going to be based in the US dollar. So depending on your opinion of whether the buck is going up or down, we can use this to take advantage of the strong moves in commodities. Last but not least, this is inflation. This is going to be another economic high point. Now, fundamentally, inflation can mean a variety of things. We'll go into full detail on the dollar picture and how it's going to affect our commodities. So everybody with me so far? Give me a yes if everybody is A-OK and ready to move on. All right, good to hear, guys. We are ready to get to the meat and potatoes and talk about the store of value for gold. Now, I briefly alluded to this, but gold has been traded for years, years, and years. Last time I did research, they said it was estimated to be a medium of exchange for over 6,000 years. Now, how long has the dollar been around? How long has the euro been around? Not too long. Gold has been that asset that everybody turns to year after year after year. Millennia after millennia, it has been known to be a store of value. It's something that we can trade between each other. Whether we all speak English or whether we all speak another language, if I have a bar of gold, we can do business. If I show up at a gold coin overseas, guess what? I guarantee I will be able to find somebody willing to accept it. Hands down, no questions asked. Why? It's a well-known medium for exchange, and everybody knows the value. There's no disputing it. There's no question about it. We can pull up our chart, get that spot price, and know exactly what we can buy with that gold. That's what makes it such a great store historically. Time and time again, people looking to use that for a transfer of exchange. Now, we talked a little bit about gold being used as a conductor, and mostly it's going to be used in electronics and wiring. Now, oil is going to have many different uses. Now, when I speak of oil, just raise your hands. Who here thinks of petrol that you put in your car? I know that's me. And I'm a little biased. I did a little research for this topic and found out a million different uses for oil. Guys, it's apparently in everything. It's in the rubber in my shoes. It's going to be used in cleaning agents. Clorox, I didn't even know this was a byproduct of oil. Melted down to its raw molecular level to be used in cleaning agents. So it's just not petrol prices that we can see a rise in oil. It's also going to be a consumer-based decision. As we see everything that we use in our day-to-day lives, so those prices go up, we're actually already trading our opinion in oil. Now, our next topic here is the dollar decline. Who would disagree that our dollar is not going as far as it used to? Me, I was able to go to Starbucks and buy a cup of coffee. We joked about this, about a cup of Joe at Starbucks. We can all see that a cup of coffee now may cost up to $5. Now, what were we paying for coffee just a few years ago? Depends on where you live. And generally speaking, who here is from an international location? All right. Sir, do you mind telling us, are prices in your country generally higher or lower than what they were, say, 5 years ago? They're higher. They're higher here in the United States. It's going to be the inflation that we're seeing around the world, but particularly the dollar is going to hit home because it's going to be the direct side of our assets. Oil and gold being priced in dollars for today's presentation. Lastly, why is the dollar declining? It is going to be due to dismal fundamentals. Guys, it is more than just political bickering. Some horrific numbers have been coming out stateside, which has really declined the value of the dollar. We need to keep this in mind when we look at the buck in relationship to these commodities. Now, guys, just a show of hands, who is familiar with the Dow Jones FXCM US Dollar Index? All right, I see about a third of you are familiar. This is a brand new product. It is available to our international clients overseas, and this is going to show us directly how the dollar is moving. What's great about this is that we are seeing a composite of currencies. This dollar index, it's going to combine the euro dollar, the pound dollar, the Aussie dollar, and the dollar yen. And it's all going to be put here on the graph in an equally weighted average. Now, this is a great way to size up where the dollar is going. Now, guys, raise your hand if you think that we're in an uptrend here. All right, guys, show of hands. Who thinks that we are in a downtrend on this particular chart? Absolutely. I ought to see 100 hands in this room flying up because we can see this chart moving from that upper left-hand corner all the way down to the bottom right. Now, who here took trend trading with Richard Crivo a little bit earlier? He went into depth in regards to finding the trend. We can do the same here with simple chart analysis. We want to find our highs, we want to find our lows, and see if we can't find levels of support and resistance. Now, I posted this chart just about a month and a half ago while I was writing this presentation. Since that time, we've seen a slight rebound back in the dollar. Now, whether it's going to go higher or lower, that's up for fate to decide. I'm keeping my eye on this index for this line of resistance. We can see it right here with our trend line, right near the 9,600 level. Knowing that my trend is down, this is going to be a reasonable spot where we can look for another dollar decline. Guess what? If it breaks above, hey, I'm equal opportunistic when it comes to trading. I will buy as well as sell as long as we have an idea of which direction the market is going. This dollar index is going to greatly simplify things, and if you don't have access to it, I challenge you to walk outside at the end of this presentation and have one of my colleagues sign you up for one of our demos containing the dollar index. Even if you just use it as a resource to find out where the price of the buck is going. All right, inflation. Going back to it, we can see that inflation, guys, this is simply going to be the reduction of our purchasing power. We talked about this earlier. We can see that we are able to buy less with our dollars. Well, this is just putting a term with that name. We know what's going on. Inflation, just a fancy economic term that we put with it. Essentially, we're looking at a rise in prices relative to the dollar. What I am more interested in, guys, not necessarily the term inflation, but how we measure it. This is going to be the Consumer Price Index. Now, just a brief show of hands, who has heard of CPI or the Consumer Price Index? All right, guys, wow, you are making me look like a pro. You are one step ahead of the game. We'll fly right through this slide then. Really, CPI, this is going to be an economic indicator that's put out by the U.S. Bureau of Labor and Statistics, and it is showing us really a change in prices. They're comparing a number of consumer goods relative to the dollar and finding out whether prices are going up or down. Now, you guys are already familiar with CPI. That is great. But if you're unfamiliar, you can always find out information on where CPI stands on dailyfx.com. Guys, this number is going to be released once a month, giving us an update of where prices are heading. I would say go to dailyfx.com/calendar, and you'll be able to take a look at not only CPI, but other economic events affecting the buck. So great. Moving on, I want to show you a visual example of CPI. Here we have it. We've discussed that our dollar is buying us less. This is going to be in turn showing us that inflation is going higher. Guys, this is just a culmination of everything that we've talked about. We can see here, all the way back in July of 2009, guess what? Inflation was at a low. Wow, we can see it was at -2%. Since that time, guess what? Another story's happened. We can see over the last 2 years, we've really had that devaluation of the dollar. We can see CPI steadily going higher and reaching that recent 2-year high at just under 4%. Now, this has been updated over the last 2 months, and we are seeing CPI surpass 4% at this time. Now, the trend is up, guys. And if the trend is our friend, hey, we're going to look for price to maintain that momentum. So relatively speaking, we can look at this as an indicator of where the dollar is potentially going in the future. So great, keep that up, keep that in mind when placing your trades, and always refer to that economic calendar if you want to see these numbers in real time as they're released. All right, here we have U.S. oil. It's also known as WTI, that is West Texas Intermediate. Hey, we like to call it Texas tea out in Dallas. This is what is produced in our backyard. We are manufacturing and refining WTI. And here we can see, over the past 2 years, when we've seen inflation rising, guess what's happened with our chart? U.S. oil going up, moving higher and reaching that high at $110 a barrel. Now, this is making new highs and going higher at present. Since I've drawn this graph, WTI has dropped off a little bit. There's been a fundamental shift in the market. We can now see WTI trading at just about $86.50 a barrel. Now, the trend is still overall up, and we're going to talk about different ways to trade your opinion, and we'll discuss that opinion in full detail. If you think this graph is going to make lower lows, if we can break out underneath the $70 a barrel handle, we may see another drop-off on the graph. However, at present, we have to rely on the data at hand, and over the past 2 years, we've seen a steady increase in price, all the way down at $30 a barrel, reaching a high of $110 a barrel. Now, I don't know about you, there's not many investments that I know of that are going to have such a rapid ascent. That's nearly 4 times the price at $30. Not saying that it couldn't equally fall down just as fast, but keeping in mind that overall trend when we start looking at the fundamental factors of oil. Here is our second chart. It is gold. Now guys, gold, who thinks that this is going to be an uptrend? Again, I ought to see everybody's hand here in the room. We have seen higher highs going up on this chart, and I am absolutely loving it every step of the way. Here we can see the low back in 2009, all the way at $700 an ounce. Slow but steady, leisurely walking up the charts, we have seen it make higher highs on the graph. Now, before we proceed, if we were to reconvene here at the Rio Hotel and Casino here in Las Vegas next year, if I was to host the same presentation, who would say that gold is going to be higher than $1,900 an ounce? Just a show of hands. All right, guys, great. Who would say that it's going to be lower? Again, no right or wrong answer here. All right? Thank you, sir. Now, why I ask that question is that we can have a room of 100 different people and all come to a different conclusion. And what are we going to base those decisions on? It may be geographic location, how we feel about the dollar, or just prices around us. How do we trade those? Well, we're going to trade them with correlations. Looking at that uptrend, I know the majority of you here are trading a US-based account with FXCM. If you don't have access to the CFD for gold, hey, that's okay. There's actually some great benefits for trading the different currency pairs. We'll use that through correlations. And first, we just need to understand what a correlation is. Guys, all we're going to be doing is measuring how one currency is going to measure compared to the underlying commodity. We'll put up the charts. We'll see which way they move. And guess what? If they move the same direction, being a perfect correlation, that is going to be +1. That would be a 100% perfect correlation. Now, there are few 100% correlations here in the marketplace. However, we are going to look at some of the great correlations that are going to move lock and step with many of the different commodities that we have. Also, we want to be aware of negative correlations. We will talk about that as well. A negative correlation is going to be a -%. This means that our assets should be heading in opposite directions on our chart. All right, here we go. Oil. It's going to be our first correlation that we are going to look at. Just a brief rundown of what we have already discussed. Oil affects everybody. Going to be used in daily consumer products. Going to be used in your car. Well, the different factors that are going to change our chart are going to be based on volatility with supply threats. Now, who here is familiar with what was going on in Libya over the last several months? All right. Now, Libya is an oil-producing nation. You'll find that when that supply is cut, guess what? Prices increase. There's been speculation that with the end of the conflict, more oil will hit the market. And guess what? When supply increases, prices drop. This is another reason why we've seen oil go down in recent months. This is going to be one of the supply threats that we have in regards to oil. Now, it doesn't just have to be geographic. It can be geopolitics. Anything that could happen in an oil-producing nation could cause instability, whether it be our friends over in the Middle East. It could be our Canadian neighbors to the north. It could be Mexico. Any of this disrupting the supply chain could throw a kink into oil. Last but not least, weather disasters. Guess what we saw? We had a hurricane go up the northeast coast of the United States just a few months ago. Guess what? There was a temporary supply threat. They thought that they were not going to have enough resources to meet the demand for energy. All of these things are going to be opinions that we can trade on our chart. Now, here we go. We are putting the rubber down to the pavement and talking about our first currency correlation, and this is going to be the dollar CAD. Now, why is the dollar CAD going to be a great correlation? Hey, they are the second largest producer of oil next to Saudi Arabia. Next, the United States, we're going to be a net importer of oil, and guess where we get that from? We get that from our neighbors to the north. As we keep on buying oil from them, it's a supply and demand function. As we demand more oil, price will continue to go up. Likewise, if that demand slacks, guess what happens? Our neighbors to the north, the Canadians, will suffer. This is what makes it a great correlation that we can use. Last but not least, the dollar CAD is going to be affected by the amount of crude inventories that the USA is holding. Guys, crude inventory is just another economic indicator that we have at our disposal that we can find on the graph. This is going to be released once a quarter, and it's going to show us exactly how much oil the United States has in reserves. Again, this is going back to a direct supply and demand function. The more we have in reserves, hey, we have excess oil, prices tend to be suppressed. Likewise, if we see those reserves deplete, if we are tapping into those oil resources during a crisis, guess what? Prices are going higher. We're seeing a depletion of that supply as demand screams higher. Now, here's the correlation put directly on the chart. Guys, here we can see that we have an inverse correlation. We see the dollar CAD moving lower from the upper left of our chart down to the bottom right. Now, when this downtrend started back in 2008, we can see 130 was the high. The dollar being valued much higher than their Canadian counterpoint. Guess what? That trend has gone down. We're now seeing the dollar CAD at the time of this screenshot trading at 94.62. Now again, the charts have updated a little bit. Specifically on Friday, we see the dollar on a bit of a rally. But the key here is to understand that U.S. oil is going to move in the opposing direction. As the Canadian economy gains steam, as oil gains value, you'll see the two will cross in the charts. This is exactly what we saw back in 2010. The Canadian dollar actually took command of the dollar. Guess what? Oil prices were going higher. This is going to be one way that we can trade, regardless of our opinion on this asset, knowing that we have a negative correlation, we can use that to our advantage. Now, many of you may have heard about the dollar CAD correlation. Here's one that's going to be a little less known. Who here likes to trade yen crosses? Just give me a raise of hands. I'm a big fan. I love the volatility. I love the pairs. The CAD yen is one that we often skip over. Generally speaking, we're going to be attracted to the big movers like the pound yen. Well, the CAD yen has its value seeped away in its correlation with oil. Guys, this is an excellent trade that we can take because Japan is absolutely not going to produce any oil. None at all. There's no resources on their island in regards to oil. So they need to import nearly all of their oil. Now they get that from a variety of different resources. The key here is that they are going to be the third largest importer in the world. That's only next to the United States and China. And guys, we consume a lot of oil out there. Japan as well, needing to buy all of it with no national resources at their disposal. So taking a look, here is a positive correlation. We can see that they are going to be traveling in the exact same pattern. As we can see the CAD yen moving from the lower left to the upper right in recent times. Likewise, U.S. oil also moving higher. Now, this isn't a perfect correlation, and I'm surprised nobody's asked why there's a little bit of differentiation between the two graphs. You'll see economic forces will push and pull at these two different assets. A correlation is going to give us a direction and give us an opinion. However, the underlying asset, oil, is going to be really spurred on by those economic events and that political unrest. If something happens in the Middle East, the Canadian economy may not be directly involved. Because of that, we may not see such a shock on the CAD yen. Whereas we see oil prices spike up at present, this is something that we need to consider, that underlying factor. Now, that can also be a great way to trade if we're looking for those oil correlations to come back together. We can reasonably assume one of two things is going to happen. Either the CAD yen is going to go higher and lockstep back with that U.S. oil correlation, or U.S. oil is going to decline, go down in price, and meet the CAD yen. Guess what happened? Over that last month, we saw that spread really collapse, and we saw WTI moving back down again to $86.50 per barrel and going ahead and locking back in with the CAD yen. So this is a great way that we can use correlations and use our charts to our advantage. When the supply of oil is cut off from the market, there's going to be an instant snap and reaction in prices. It's again something that you use on a daily basis. It's something that I use, nations use across the world. The Canadian economy is going to take a little bit of time to catch up with that. They're sitting there producing oil, and it will eventually correlate back together. Now, again, using those geopolitics, we can use the spread between the two prices and even base a trade decision on that. Now, who here is familiar with the carry trade? Guys, just give me a quick raise of hands. All right, excellent. This is going to be one of the great ways that we can trade oil and get the cost of carry in our favor. And before we started the presentation, some people said, hey, Walker, why wouldn't I just trade the underlying asset? Why wouldn't I just trade WTI? Well, hey, if you're a bull, if you're going long WTI, that's great. For the last 2 years, you have been making money up and down the block. I congratulate you, your account balance is better for it. However, if you were to look at the CAD yen, you'd actually be able to earn interest on this graph. Now, right now, the central banking rate for the Canadian dollar is right at 1%. The Japanese yen has a central banking rate of 0.1%. Now, that's only 0.9%, but it's no chicken feed if we use that power to our advantage for extended periods of time. Also, if you think there's going to be growth out of Canada, if they increase that interest rate, guess what? Your carry cost just goes up and you're making interest while you take that trade. So if you're a bull, it's worth your time to trade the Canadian yen. You'll make that daily rollover interest, whereas if you just trade the underlying asset, US oil, guess what? You get nada. You get no rollover for holding that particular trade. So it's something we can use to our advantage with currency correlations. Where can I find the interest rates? Well, you'll find it inside of your FXCM platform. We discussed this briefly earlier at the top of the hour. It's inside your dealing rates window. It's going to be the simple dealing rates, not the big boxes you see on the platform. It's going to be on the small boxes that look like an Excel spreadsheet. Now, there's going to be a column. It says rollover S and rollover B. If we are buying the CAD yen, that means we're looking at rollover B. This will show us how much that we are going to earn per lot on our trade. So it looks like we've got a little mixed opinion here in regards to oil. Guys, it's not quite as easy to read as gold. Gold just being strictly phenomenal, and that is going to be what we're basing the rest of our presentation off today. Now, without further ado, the shiny metal. Guys, here we go. We have it as a store of value, a hedge against inflation. It is globally recognized and traded. Now, I just wanted to reiterate these points. We talked about them at the top of the hour. I want to bring them up again. I know we were focusing on oil. I want to make sure that we're successful, able to switch gears and move on to our next asset in regards to the supply and demand factors on the precious metal of gold. Why do we trade gold? Well, it's correlated with the Aussie dollar. Why? Just like the Canadian dollar being correlated directly with oil, we can see the Aussie is going to be correlated with gold. It is the world's second largest producer of the metal. Now, can anybody tell me who is the #1 producer of gold in the world? South Africa. Yes, you've got it. You get a high five, good sir. You are right on the money. South Africa being #1. Australian dollar going to be correlated because they are the second largest producer. And here we go. 225 metric tons of the stuff is pulled out of the ground by the Aussie every year. Likewise, here we go. We can see that the Aussie has an 84% positive correlation. So there we go. We can see that 84% of the time, we can reasonably expect that these two assets will move in the same direction. Just to simplify, as gold prices rise, hey, we can reasonably expect the Aussie dollar to do the same. So let's get down to it and look at the chart. Here we have the direct correlation, and both graphs being very compelling, moving from the bottom left to the upper right on our chart. And I don't think anybody would debate both of these assets in an uptrend. Certainly, if you want to argue that, I would be happy to hand you the mic and you could continue giving this presentation. But both being a very strong uptrend, both going to be something that we can see moving in a strong directional bias. Now, just like you said in regards to that correlation percentage, we can see that 84% of the time we can expect them to head in the same direction. Do you see this gap that we have in the chart all the way back in 08, where we can see the Aussie dollar being depressed but oil going higher, or excuse me, gold going higher? These are going to be those points of separation. Again, we can use that, the power of the correlation, to our advantage. guess what? One of two things is going to happen. Either gold was going to decline and catch up with the Aussie dollar, or the Aussie dollar was going to increase and continue with that correlation. So if you're a gold bug, you think that gold is going to march higher and you see the Aussie dollar suppressed, guess what? You had the potential to earn, I think it was just about 150 pips on that trade while that correlation caught up to each other. This is just another different way that you can use this to your full advantage. If you have a bullish bias, we should always be looking to buy the Aussie dollar. Here we can see gold reaching way up above at 116. We know it's since moved higher to 119. The Aussie dollar has also had a big move. At the time of this graph, it is at 108.39. It's reached a high of over $1.10. Since this time, we know both assets have gone down. Just showing the correlation works, we have seen gold drop off of its highs, trading at 1863. We've also seen a decrease on the Aussie dollar, moving down over the last week, closing trading right at, yes, it was $1.04 and change on that particular graph. Now, looking at the Aussie dollar, just to reiterate the high points, guys, strong correlation. It's been occurring for nearly a decade. So keep in mind, if we are bullish, we want to be buying that Aussie dollar. Now, last but not least, we have the lowly dollar Swiss. This is one that's going to be big in the news. Everybody talking about the Swiss National Bank and their intervention. And I've walked around. I think I've heard it in nearly every presentation in this expo. Now, I'm going to go a completely different route, guys. I'm not going to talk about intervention. I want to be talking about this safe haven currency and how it is correlated to gold. Now, just a show of hands, who thinks the dollar Swiss is positively correlated to gold? Who thinks it's negatively correlated? All right, we're going to find out here in just a second. The reason that we are going to trade this is its safe haven value. We see that people move their money to the Swiss for their safety of funds. Mostly Europeans, this time of economic crisis, guess what? They are pouring their money into Switzerland. They are getting it out of Europe as fast as they humanly can. They're going to their neighbors in the center of the continent, putting a large demand on their currency. Likewise, gold going to be considered a safe haven asset. That safe haven asset, as people move to safety, gold, as we've seen, will move higher. Now, that was kind of a trick question in regards to the correlation. It is right here on the slide. We can see that the dollar Swiss has a negative 76% correlation. So whereas the Aussie dollar and gold move in the same direction, guess what? The dollar Swiss and gold are going to move in opposing directions. Here we go. All out on the chart, nothing to hide here. We can see the crisscross in regards to the dollar Swiss. Here we can see its rapid descent. We can see it all the way at the top of the chart, right at 1.20. Since that time, we have seen the dollar Swiss move to all-time lows. It's up a little bit higher now, but hey, no problem, because what does that tell us about gold? If the dollar Swiss is going up, which way is gold going? Down. All right, you've got it. And that is going back to our opinion, where we saw gold go off of its highs right at $1,900 an ounce, trading now approximately $200 lower. Likewise, we can see since this chart was put up, the dollar Swiss also reaching an extreme, all-time lows. Well, guess what? It is backed off of that low and slowly moving upwards. The key here, guys, is to look at the cross and see that, hey, if we think that gold is going to continue higher, guess what? That's going to be people looking for those safety of funds. They don't want to hold their money in cash. They are moving it to gold. So guess what? We sell the dollar Swiss. Likewise, if we have the opposing opinion, let's say that we think that the commodity is going down. We think that gold is going lower. The dollar Swiss is going to be a great alternative to buy. And we talked about rollover interest and how much that we would earn on the Aussie dollar if we bought. Guess what? If we sell, we got to pay that amount. That's going to be out of pocket for selling that Aussie dollar correlation. This is what makes the dollar Swiss so lucrative for an alternative scenario where we think gold is going down. If we think that the trend is done, we think it's diminished, we have a bearish opinion on gold, guys, it is worth our time to buy the dollar Swiss, because every day we're not going to be hemorrhaging money in rollover interest. So this is one, if we see gold decline, I'm keeping this on my radar for a future surge in the dollar Swiss. Likewise, if it declines, hey, no problem. We can hop back on that Aussie dollar and ride it to higher highs. So that is going to be the key point, that we can trade our opinion on these two assets, make a judgment decision on the economics behind it, and then maximize our trading opinion and that daily rollover interest as well. Now, here we go. Just to reiterate the points we just discussed, how to trade. We are looking at this in a bearish stance. We only want to trade the dollar Swiss if we think that gold is going lower. Well, hey, let's go ahead and take full advantage of that, using that rollover interest to our advantage in a short scenario. Last but not least, I only want to hit on this briefly. The Aussie dollar, a bit more volatile. If you're a more conservative trader, then absolutely this may be the asset for you to trade. Now, guys, I'm going to go ahead and wrap up here. This is going to be the summation of the day, just talking about the different currency correlations. I know we have covered a lot of information here. Some of it going to be fundamental, some of it going to be technical in nature, but really we want to use these correlations to our benefit. If we have an idea of where these commodities are going, using all of the different ideas that we've discussed today, we can go out in the market, trade one of our pairs, and take full advantage of that. Last but not least, using that volatility, like we discussed, with gold having that greater edge in regards to volatility to the Aussie dollar, we can always use those differentiations and spread to our full advantage. Now, guys, I know they're being released out in the hallway. I'm going to open up this question. I'm going to take questions until they literally throw me out of the room. If you have to leave, meet your buddies. I absolutely understand. I won't take it personally. But do me the favor, there is a comment card in the back. If you weren't able to get any of your questions answered here today, feel free to fill that out. I'm going to take those home with me to the office, and as time allows, I will email each and every one of you back as time permits. So I thank you, and I'm just going to open up the floor for questions. Hit me with your best shot, guys. What would you like to know more about?